Welcome back to another video, and today we're going to be talking about, well, the stock market crashes and corrections, because at the moment, obviously, we're in a correction, you can say, because we have gone to that 10% mark in the S&P 500 nearly, and the QQQs, I believe, are about 10-11% down, and then the Russell 2000's getting to the point where it's nearly a crash because it's down 17-18%. So I thought, let's do a video because a lot of people are panicking, and you should reverse engineer it and be like more of like this is a buying opportunity. Everyone says it's a buying opportunity when markets crash, markets go into corrections. If you're getting into the right stocks and the right valuations, then it's an opportunity. It's literally a fire sale, Black Friday kind of situation. And that's how you should look at it. In the short term, it is obviously painful and it's very, very hard, but long term, you could get rewarded. Anyway, if you're new to the stock market or want to get involved with investing and want a free fractional share worth up to £100, then use code BEN or link in the description and you'll get a free fractional share worth up to £100. You can also do it if you've already signed up to Trading 212 within 10 days, so make sure to also use the code BEN. So we're going to go over some graphs to show you some data of how long corrections last, how many crashes have been over the years, and it gets you an idea of, is this that bad, or how long can it keep going on for? So the first one we've got here is the stock market crashes since the 1950s, since 1950, sorry, and yeah, you can see that some have been long, 446 days, and these are crashes, by the way. The difference between crashes and corrections are, well, crashes are more than 20% and corrections are more than 10%. Anything under 10%, it's more of just a dip, you could say, and corrections are more so when they're over 10%, and then crashes are beyond 20%. So these are the crashes. So some have been really hit hard, and there are some that haven't lasted long at all, and some have gone over a year or even 2 years, which obviously is painful. And that is why it's important to always have cash on the side for when things are dipping and when things are going down, because you want to constantly be able to buy up the positions that you believe in and the ones that you've picked and get them at cheaper prices, because you've done the calculations of where you think this can go. You've done the projections, so it's just a cheap way of buying your stocks. So on average, a crash can last in days, 338 days, which is mad, which is absolutely crazy to think, really. This is another one that I've seen, so 60 years of the stock market cycles, and this is another one showing you the crashes and how long bull runs tend to last and how short crashes are compared to how long bull runs last. So as you can tell, that when there is a crash, they're almost like blips when you look at it as a long-term thing, because obviously you should be in the stock market to invest, not to trade, unless some of you guys are traders, but most of you guys are investors and you're putting the money in that you're willing to, like, that money is locked up for 5 years. You should really be looking at the time horizon should be minimum 5 years if you're investing, and you should be happy to leave that for 5 years, that money that you're putting in. If you can't, then do not be investing in the stock market, because you'll get situations where, well, we saw the data, it could last 2 years, a crash or a bear market, and if you needed the money, you'd be screwed in a way. So that's why you need to make sure you've got cash on the side to be buying the dips, and also know that you're not going to be touching this money for the next 5 years. That's how I look at it anyway. So that's just another graph that I wanted to share with you. It just puts into comparison that bull runs just last way longer than bear markets. So now we're going into the correction side of things. So obviously remember, a correction is more than 10%, between 10 and 20%, and when to expect the next correction, the average frequency of a significant stock market decline, anything that's going to be about a 5% down draw, you're looking at every year pretty much. And then anything about 10%, you're looking at 1.6 years, and then 15%, 2.5 years, and then every 4 years about 20%, which is now a crash. So every 4 years, you're kind of expected a crash. And then every 9 years, you're looking at a huge, big kind of crash happening. On average, this is, by the way, so this is sources with using the S&P 500, so using the history of the S&P 500. So yeah, so that's another thing to put into perspective. This was bound to happen. I kept saying in the Discord that we are probably going to be looking at a bit of a down draw to, well, the downside really, because we've been in this bull run for a while and we've made some crazy gains, hence why the portfolio video's going crazy, because we're in a bit of a bull run big time and things were going a bit crazy, valuations were going crazy, and it's just something it was needed. And we kept saying in the Discord, oh, when SoFi goes to 11 we'll be buying it up, there'll be a time where that will happen because there will be a correction. Well, we thought more so a correction. I didn't really believe there would be a crash as such, but still could be on the cards. But yeah, I was thinking there will be a correction at some point soon. And obviously we're kind of getting there with the correction now. So, and it also just shows you with that is like every 1.6 years you get like a 10% correction. So it was bound to happen. And that's why it's like I keep saying, it's important to have cash on the side. Corrections are common, as you can tell. Here's another graph of showing you some of the frequently of how many corrections there actually are, and normally they tend to be about the 7% range, where they're more dips, so obviously not corrections but getting near to the correction side of things. And yeah, on average it's saying about 14% the dips. So yeah, we've done 10%, like we say, roughly average with the S&P 500 we've dipped to, and we've done it very quickly. And that was another thing I was going to say, is we've gone down very fast, and that's why I've been a bit more cautious and having cash on side. But I have been buying, like I even bought today, so I've bought some more stocks. This is another graph that I thought was interesting. So average frequency about 3 times a year, 5% or more, and they last about 46 days. So I believe this has kind of started about, off the top of my head, about, I think it was 15th of Feb or 10th of Feb. So we've been around a month-ish with this whole correction side of things. 10% or more happens about once a year, 117 days. So yeah, you can see, and pause if you want to have a look at that. They do last a while, and I remember 2022 situation that lasted pretty much, I think, 11 months exactly. So it was 11 months of just downwards every day. Granted, there were times where it went up and you'll get in the green days, but then overall it was just going down and down and down. And it was a bit more of a slower process. There were times where it got hit hard, but then it started getting slower and slower, but it kept going down over time. And that was why I've also been a bit cautious of like not going all in with the cash. Even though they're great prices, there's still possibilities that they could get even better, the prices. So that's why I've not gone crazy in, but I am getting limited with cash now because I am buying. Like, don't get me wrong, I'm buying because they're good prices. But that's something I've been wary about, and that's why I've been a bit standoffy. But that's why it's important that I've got my monthly targets of how much I'm putting in a month anyway. So I'll also get, obviously when I get paid, I'll have that money to put in as well. This is almost like bonus money, bonus deposits going into the market. So as you can see here, on average, the stock market corrections, defined as a 10% drop from a recent high, lasts about 4 months. So that's it. So in total, they can last about 4 months, really. So let's just be prepared for the next 3 months to be not great. You could, because of how quickly we've gone down, that especially in the small caps kind of situation, we might just stay the same. It might just stagnate and we don't really move up or down. It could just trade a bit sideways for the next few months, which is fine. It just means we can get these good prices at these good prices for the next few months. So I would just keep just looking at the stocks that you've calculated and done the projections and you think are going to do well, the companies that you believe in. It's great to just keep buying at these great prices. And that's just, obviously that's my opinion, not financial advice, but that's what I'm doing. I'm seeing these projections of where I think AMD can go, SoFi can go, Grab can go, and I'm going to put actually the tables of like where I think my projections are for AMD, SoFi. I've already put SoFi out there on YouTube, but I'll make sure to put AMD where the projections I think AMD will be going in share price in the buys and sells group, because I haven't done that in a while. And I'll share you guys, the people that are in the buys and sells group, I'll share you where I think the projections will be with AMD. Hopefully this has helped you guys or got a bit more of an understanding and also made you feel a bit better with the stock market. And it's just something natural. It's just something that always happens in the stock market. It's not ever going to go away. You're going to get corrections. You're going to get times where it's going to go up. And it's just taking advantage of these times where they're going down. And yeah, Like I said, if you do want a free fractional share worth up to £100, then link in the description or use code Ben. And if you're brand new here, subscribe and also hit that like button. I really appreciate all the support recently. It's been insane, and we'll get through this, guys. We will, and I'll keep it up with the portfolio updates even if it gets bad.